Hello, investors, and welcome to my YouTube channel, where I study the best investors and businesses from around the world. In this week's video, we'll go over Howard Marks' thoughts on what makes a good value investor and what the current climate looks like for value investors. Howard Marks of Oaktree Management is one of my favorite investing legends. His investment knowledge and understanding of investor psychology and market dynamics are unrivaled. Given the ongoing speculative mania in the market, it might be good to review his annual letter. According to Marks, value investors understand that rather than telling us what a given asset's value is, Mr. Market offers securities at that price that can be discounted from the actual value of the stake or claim in a business. In doing so, he sometimes gives us the opportunity to snatch up shares or bonds at a meaningful discount from their intrinsic value. This requires independent thought and a temperament that resists the emotional pull of the market cycle, as well as decision-making based solely on value. These are Howard Marks' underlying principles of what makes for good value investing. Understanding securities as stakes in actual business, a focus on true worth as opposed to price, the use of fundamentals to calculate intrinsic value, the recognition that attractive investments are the result of a wide discrepancy between the price at which something is offered on the market and its actual worth. Emotional discipline to act on when such opportunities are presented and not in other circumstances. You could argue that back in the old days, people like Warren Buffett could find businesses likely to remain prominent for long periods of time and could perform straightforward analyses to assess their valuations. For instance, he could look at something like the Washington Post, which became a monopoly newspaper company in a major city, and invest on the basis of reasonable, consistent assumptions in regard to variables like circulation, subscription prices, and ad rates. It was assumed that the newspaper would remain dominant because of its strong economic moat, and that the company's past would look very much like its future. However, in contrast today, due to the global nature of markets and the ability for the internet and software to vastly increase their profit potential, technology firms or other technologically aided businesses have the capacity to become much more valuable than we previously could have imagined. Innovation and technology adaptation are happening at a much more rapid pace than ever before. It has never been easier to start a company, and there has never been more capital available to fund entrepreneurship and startups. There have also never been as many highly capable people focused on starting and building their own companies. Since many companies are now selling products primarily made with code, their costs and capital expenditures are extremely low. Also, their profitability, especially on incremental sales, is unusually high. Thus, this economy of winners has never been more attractive. Because the marginal cost of scaling a business over the internet is low, businesses can grow much more rapidly than ever before. It's become more acceptable for public companies to lose their money in the pursuit of large earnings in the future. This can obscure the real potential economics of winners and can make differentiating between winners and losers difficult. As developing and scaling new products is much easier in the digital world, often because they require little more than engineers and code, it's now possible for companies to explore new avenues of growth. For example, Amazon's AWS and Square's Cash App. This gives more value to exceptional management, engineering, talent, and strategic leveling of consumer wishes. The moats protecting today's winners have never been stronger. As Brian Arthur pointed out in Increasing Returns and the New World of Business, the winners often become stronger and more effective as they get bigger rather than more bloated and inefficient. On the other hand, the large increase in startups with readily available capital and minimal barriers to scaling means that the durability and legacy of businesses has never been more uncertain. At the same time, however, it's important to recognize that the leading tech firms face stricter antitrust laws because policymakers believe that they have developed excessive market power. To summarize, businesses are both more valuable and more dominant in today's world, with more opportunities for drastic changes in profit, whether positive or negative. On the positive side, successful businesses have more potential for long spurts of high growth, superior economics, and significant durability. This creates a huge pot of gold at the end of the rainbow and helps justify valuations that are remarkably high by historical standards. On the negative side, this also tempts investors to overvalue undeserving companies. And companies with here and now cash flows that seem stable can see those gains evaporate as soon as a bunch of Stanford computer science students get funding and traction for their new idea. As you may already know, Warren Buffett is a friend and a fan of Howard Marks. Buffett has been quoted as saying, "When I see memos from Howard Marks in my mail, they're the first thing that I open and read." So, on this channel, I hope to cover learning from his letters in the coming videos. Let me know if you think that Howard Marks missed anything from his thoughts from the current economic climate. Thank you for watching this video entirely to the end. Nothing helps me out more than y'all sticking it out until the end, and please consider subscribing to my channel if you haven't already done so. Also, if you enjoyed this video, please like the video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.